Hey investor friends, I'm Michelle Markey, and today I'm going to explain the 5 main stock market order types, and these include market order, limit order, stop loss, stop limit, and trailing stop. And this represents the what and how you want to buy a stock through your brokerage account. And then I'll also explain what the time and force condition means, which is just when you want to buy a stock. And if you haven't already, I'd love if you could please like and subscribe to my video and YouTube channel because it greatly helps out with the YouTube algorithm, and I greatly appreciate it. Thanks. Even if you haven't bought a stock yet, the experience of buying a market or limit order can be a lot like real life experiences. Like, let's say you go to a garage sale or yard sale, depending on what part of the country you're in, and let's say you see a bunch of free weights that you might like to buy, and you see that the garage sale owner is currently selling a pair of 5-pound dumbbells for $5, and then he's also selling a pair of 10-pound dumbbells for $10. And then you go to him and say, look, I don't want to pay $15 for the total of 4 dumbbells. I only want to pay $12. And then the garage sale seller might say, look, I can't give it to you for $12, but how about 13? And then that's his market price, but your limit price was $12. So maybe you meet him halfway as you're reacting to the market price, and you reset your limit price up to $12.50, and then the seller accepts. So you may have already experienced a way that you can do market and limit orders in your daily life. When you're ready to buy or sell a stock of a publicly traded company, you'll usually submit your order through a brokerage firm such as Fidelity, TD Ameritrade, Charles Schwab, Vanguard, and many other brokerage firms, and they will take your order to a stock market exchange such as the New York Stock Exchange or NASDAQ, in which the security you're interested in is listed, and then they will try to get the best possible price for your order. And with that, let's say we're using Fidelity's brokerage website or app, and then we want to buy or sell Starbucks as a stock represented by ticker symbol SBUCKS. And so if I pull up their trade module, I can see that I can put in the ticker symbol of SBUCKS, and then I can specify the action, buy or sell, and then I can put in the quantity, at least 1 or maybe a fraction or more. And then I can also decide what order type I'd like to have. So then if I choose the order type, I would see a list of up to 8 options possible for doing this trade. And then let's say I want to decide what time and force I want to buy or sell this stock in. And so I can also select for how long my order will be valid for. It can be overwhelming at first to see so many order types, and you feel like you have to know what each and every one of them are before you make a move. But in reality, if you're a long-term investor, the main 2 types of orders that are relevant to you are usually a market order or limit order, and the remaining options give flexibility to traders who usually need that kind of flexibility to make certain maneuvers in the markets depending on their short-term actions. So just keep this in mind. If you're a long-term buy and hold type of person, the main 2 types of orders that you'll likely use are market and limit. The stock market is usually open between the hours of 9:30 a.m. to 4 p.m. Eastern Time, and these market hours can change on certain federal holidays, so they might have partial opening hours or they might be closed altogether. So make sure you check before you place any orders. And so when the market is open, usually the prices fluctuate for any given stock, and you may see them go up and down by cents or dollars. And so this refers to a stock's price being volatile, and it can either be more volatile, like the price is rapidly changing and maybe going through extreme degrees of change, like going through a lot of ups and downs, or it might not be so volatile, and then the price might be staying relatively close to a steady amount. But either way, usually stocks are liquid, and that means that they're trading at all times, and then people are buying and selling at various prices. So you'll see the market prices change quite a bit when the market is open. And for purposes of today's example, I'm going to use Starbucks' stock prices when the market wasn't open, just so I have a steady number to refer to. And so let's say at the time I referenced the Starbucks stock, it was trading at close at $112.92 per share. And so the bid price was $112.87, which is the lowest price that a seller is willing to sell the stock at. And then the highest price a buyer is usually willing to pay for a stock is at the ask price, or in this case, $112.99. So this is known as the bid and ask spread. And so when you place a market order, your order will execute at the next available price, usually somewhere in the range of this bid and ask spread. So if you're buying a stock, it might end up being closer to the price of $112.99 when you're filling your buy order. And so if you're basing what you're trying to buy the stock at the last traded price, it may not really end up at that price. It may be slightly above or below that, depending on how much the stock price is fluctuating at that moment in time. So you could end up paying more or less in a market order. So just because it says estimated, it means that it's not the final price. And usually you can preview and then you can see that the price might still be changing as you're reviewing your order. And then when you finally place the market order, you will know what the final market price was that you bought the stock at. Also note that market orders generally receive higher priority to fill than limit orders, which I'll explain in a little bit. And keep in mind that you usually want to use brokers that give you the best order execution quality, both in terms of time to execute and price. And so with time to execute, most common brokerage firms can do this in a fraction of a second, like some as low as 0.05 seconds, and some might be a little bit higher on this spectrum of up to 0.39 seconds. So just bear that in mind if you're considering how long it will take for your order to execute, as well as you want to get the best possible price on each of the shares you're buying. So with some of the brokers, you can also see that they try to get you the best price improvement on each and every share that you're buying. When you place a limit order, you're instructing your broker with the maximum price you're willing to buy shares at, or the minimum price at which you're willing to sell shares at. And so when you put a limit buy order, this means that you want to get filled at the price you specify or less. So if we take Starbucks, which has a current market price of $112.92, and I put a limit buy order of $110, that means that I could be placed the shares at either my buy price of $110 or less. Like if the price goes down to $109, then it could still put the stock to me because that's a better price than what I'm willing to pay at $110. And on the flip side, with the limit sell order, let's say the minimum I'm willing to accept is $115 to sell my Starbucks shares. And then maybe the market price suddenly goes to $117, which is $2 better than the limit at which I'm willing to sell. So then I might get to sell the shares at $2 above my limit price. So based on this, keep in mind that your limit price is the minimum or maximum at which you're willing to sell or buy respectively. And then I have additional notes in which, depending on available shares at the limit price, the order may or may not fill at all, or it may partially fill, and it's not guaranteed to fill, especially if the stock price gaps rapidly away from the limit price. And limit orders may have higher execution costs than market orders, and limit orders can be seen by the market. And this is a little bit different from stop orders, which I'll get into a second. And unlike limit orders, a stop or stop loss order cannot be seen by the market. So this can be a handy option if you want to make some stealthy market maneuvers. And with a stop loss order, you're saying to the market, when your stock hits this price, you want it to fill a market order, and it may or may not do so. So let's take the Starbucks example again. And for purposes of just being more clear, I'm going to refer to stop in terms of stop buy and then stop loss in terms of selling. So as to keep it a little bit more easy to understand. And so with the stop buy order, if Starbucks's price hits $113, then I want it to buy it at $113 or above. And conversely, if I want to do a stop loss sell order, I want it to sell at $110 or below. And so what this means is once the stop price hits, the buy order may buy at or above the stop, or a sell order may sell at or below the stop. And like I said, stop loss fits better with sell orders to reduce the potential amount of loss when you're selling. And it's not guaranteed to fill at your exact stop if the price gaps rapidly. So even though you put this market order along with a stop, if the price is moving too much, it may go way past the stop price at which you specified. And then a stop limit order is sort of similar to a stop loss order, but instead of a market order, a stop limit order is a limit order that if the price reaches the stop price, then you're saying you want the market to try to fill a limit order that you've placed. And so when we take Starbucks again and we want to do a stop limit buy of Starbucks, if the price stops at $113, we only want to buy Starbucks stock at $112. So this has the benefit of limiting the exact price at which you want to buy. So it's not going to wiggle away a little bit in a market order. In a limit order, you're being very specific that you're only willing to accept buying the Starbucks stock at $112. And then similarly with the stop limit, you're saying that if the price hits $111, then the limit at which you're willing to sell the Starbucks stock is $110. And so as soon as the stop price hits, the limit order is activated and may execute at the limit price, and there may be possible partial or no fills. And if at the start of trading versus the previous day's close, the stock price gaps up or down way past the limit price, then the order would likely not be filled. And so you have some added protection that if the price doesn't hit the limit price that you've set, then you don't have to worry about being filled. And this is a little bit different than just a stop loss order where you could risk still being put the shares because you're able to buy it at the market price. Unlike with the limit order where you're saying if it doesn't hit my limit price exactly, then don't give it to me. The fifth order type is a trailing stop order, which is a modification of the typical stop order set at a certain dollar or percentage amount. And it can either be a market or limit order. And trailing stop orders move with the current market price of a stock, and they move in one direction as they're designed to lock in profits or limit losses. And so let's take our Starbucks example again, where if we want to put a trailing stop buy at $113.99, this means that I put a trailing stop loss in the dollar amount and I put a trailing amount of $1 and I based it on the ask price. And you can base the trail amounts on different qualifiers such as the last traded price or bid price or ask price. So in this instance, I chose the ask price. So this means that if the Starbucks stock stops at the price of $112.99, I want my trailing stop order to be activated, and then I'll buy it if the stock hits at $113.99. And conversely, we can do a similar thing with the trailing stop sell order. And if we stop the price at $112.99, then we're saying we want to sell the stock at $111.99. So with all that being said, a trailing stop is more flexible than a fixed stop loss order because it's tracking the stock price, and you can set flexible dollar or percentage amounts within the range that you want to stick to the stock price in case you want to have a certain market order or limit order go through. And then just keep in mind that, interestingly, a trailing stop buy and sell order are mirrors of each other. So you can see that conveniently they're sort of tracking in a similar way and they're kind of opposites. Finally, you can choose for how long you want your order to be active for when you set a time and force condition. And for most people, they select just a day order, which means if you have an order in, it can fill at any time during the open hours of the market that one day. And if it doesn't get filled, then it either expires or cancels at the end of the market day at 4 p.m. And so if you do an order that's outside of the stock market's opening hours, then it will try to put it in force during the next day. And it will only be valid if you have it set to a day order. And then you could also choose to have good till canceled, represented by GTC, an abbreviation. And with GTC, this means that you could sometimes have, with some brokers like Fidelity, up to 180 days in which you want this order to be active. And some other brokers might only allow you to have that order active for up to maybe 30 or 90 days. And then when we have fill or kill, this means that you want your order to be completely filled, all of the shares, or cancel the order. And then if you have immediate or cancel, then you're saying you want as many shares filled as possible and cancel the remainder if they're not filled at the price that you want them to be filled at. And then you can also have shares filled on the opening price. So if the stock market opens at 9:30, whatever the price is at that point in time, then you want it filled on the open. And in a similar way, on the close means you want the stock to be filled at whatever the closing price at 4 p.m. is for your time and force order. And so those were the 5 main order types between market order, limit order, stop loss, stop limit, and trailing stop that you could possibly choose. But like I said earlier, for the most part, many of us will only need to use market and limit orders most of the time as to not make it too complicated, especially if we're holding for the long term. And just remember, if you set certain time and force conditions like good till canceled, make sure you don't forget about it in your brokerage account adventures. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.